When SpaceX went public, it raised $75 billion and jumped approximately 19% on day one. But hidden in the S1 prospectus is an unusual lockup schedule that could pressure the stock in stages. Lockup agreements prevent insiders, founders, employees, early investors, from immediately selling their shares, which stabilizes an IPO. However, studies show prices often drop when lockups expire. For example, Field and Lowry, 2009, found that IPO stocks typically suffer a 1 to 3% permanent price drop with an approximately 38% jump in volume around lockup expiration. About 60% of IPOs experienced price declines at lockup end. In practice, once insiders are free to sell, share supply surges and prices often dip. It's axiomatic that lockup expirations can trigger downward pressure. Facebook's 2012 IPO, for instance, fell approximately 50% in the months after IPO as insiders finally dumped stock. Lockups exist to give the market a cooling-off period. Without them, early investors could unload shares immediately, flooding the market and collapsing the price. In SpaceX's case, the prospectus enforces a complex, staggered release of shares, unlike the simple 180-day cliff seen in most IPOs. Understanding this schedule is crucial. SpaceX's unusual staggered unlock timeline. Instead of one expiration, SpaceX's prospectus spells out multiple unlock events. All references below from the SpaceX S1's prospectus. After Q2 2026 earnings, approximately mid-July to September 2026, up to 20% of locked shares may be sold. Performance trigger, pre-Q2. If SpaceX trades greater than or equal to 130% of IPO price on 5 out of 10 days before the Q2 earnings release, an extra 10% unlocks immediately after. Thus, a 30% rally before Q2 would accelerate the initial unlock. Scheduled tranches. 5 tranches of approximately 7% each unlock at roughly 70, 90, 105, 120, and 135 days after the IPO. These releases occur roughly every 2 to 3 weeks in July to September 2026. After Q3 2026 earnings, approximately mid-October to December 2026, an additional 28% becomes transferable. Day 180, approximately December 2026, all remaining locked shares are freed. Importantly, Elon Musk's own shares are not part of the 180-day lockup. The founder agreed to a 366-day lockup, meaning he can't sell any shares for over a year, well past these stage dates. Musk's commitment, controlling greater than 50% of votes, signals long-term conviction. But other insiders, employees, VCs, secondary buyers, are on the 180-day schedule above. In short, most IPO investors normally watch one lockup date. SpaceX shareholders face 6 main unlock events over 6 months. Historical IPO lockup effects. Empirical studies and past IPOs confirm that lockup expirations can drive volatility. Field and Lowry, 2009, show that on average, IPO stocks see a permanent 1 to 3% price drop at lockup end and approximately 38% higher trading volume. About 60% of IPOs have price declines on the lockup expiration date. This suggests that even fully anticipated supply increases can push prices down. Cooley's market analysis notes it's axiomatic that lockup expirations can cause a stock price hit as insiders flood the market. Real-world examples. Facebook's 2012 IPO crashed 50% after IPO. One key reason was heavy insider selling once the 180-day lockup lifted. Uber went public in 2019, $45 per share, and by its November lockup, about 763 million new shares, $20 billion, were about to hit the market. Analysts warned this could cause an avalanche of selling. Uber ultimately traded well below its IPO price as insiders sold on unlock. Airbnb and DoorDash IPO'd in late 2020 and also saw extended rallies unwind around their 6-month marks. Airbnb corrected from its peak, and DoorDash gave back much of its post-IPO gains. In contrast, not all expirations slam prices. Some locks pass with only modest dips or even small gains. For example, Lyft and Levi Strauss had minimal drop or slight rise on lockup day. But the risk of a supply shock is generally high. The key lesson: lockup timelines are known in advance, so a perfect market might pre-price these drops. In reality, many IPOs still see supply-driven sell-offs. While SpaceX's strong fundamentals, government and commercial launch revenue, proven execution, suggest long-term value, history warns that even great companies often suffer near-term corrections when big lockups end. Adding to the complexity, many SpaceX investors bought shares via multi-layer SPVs, special purpose vehicles. A recent TechCrunch report explains that SpaceX's IPO involved an unprecedented number of layered SPVs, some 4 to 5 layers deep. In these structures, one SPV owns shares in another SPV, and so on, ultimately tying into the SpaceX cap table. The upshot: individual investors are several steps removed from the actual shares. This creates notable distribution delays and uncertainty. Unknown share counts. TechCrunch notes that many downstream SPV investors might find they own fewer shares than they think, or, in rare cases, may not receive any shares at all. Until the SPVs above them actually receive and transfer stock, investors don't know their exact position. In fact, in most situations, investors won't learn how many SpaceX shares they actually own until the company's rolling lockups begin to lift. Staggered deliveries. By agreement, SPVs only distribute stock after the lockup restrictions have fully lifted for those shares. The first layer SPV, closest to the cap table, has 30 days after each lockup expiry to distribute shares to its investors. Then, the second layer SPV waits those 30+ days, and so on. As a result, TechCrunch reports that the bottom layer investors might not receive their shares until 8 or 9 months post-IPO. In other words, an investor through 4 to 5 SPVs could see months-long delays and extended lockups just to get legal title to their stock. Fee erosion. Each SPV layer typically charges fees. These stacked fees can effectively reduce the total shares passed down.
One insider quipped that some expected shares will be eroded by fees taken by the SPVs along the chain. In short, if you invested via an SPV chain, you have the added disadvantage of timing uncertainty. You are exposed to SpaceX's market moves during the lockup, but you can't act because you don't formally own or know your shares until distributions trickle down. This is a unique risk for SpaceX IPO investors compared to a direct buy. Mark all unlock dates on your calendar. Using the prospectus timeline above, note the Q2 and Q3 earnings release dates, mid-2026 and late 2026, and the 70, 90, 105, 120, 135 day marks. Those are the days when chunks of shares become tradable. Expect heightened volume and volatility around each date. Monitor trading volume and price. A spike in volume or a sharp price move on an unlock date likely signals insiders selling. That doesn't guarantee a crash, but it's an alert. Informed investors use these signals to adjust risk exposure, not to react emotionally. Do your own analysis. Don't base decisions on hype or fear. Review the S1 yourself if possible. Understand that multiple sell-offs are scheduled. These aren't rumors, but SEC-filed commitments. Keep your long-term thesis in mind. A strong business model may weather these storms, but short-term swings are likely. Check your SPV details. If you invested via an SPV, contact the SPV manager now. Ask, when will I receive my shares? How many will I get? When does my position legally become active? You need clarity before any unlock event happens. The TechCrunch report suggests these answers often come only after the IPO, so push for documentation. Plan tax/liquidity strategy. Consult a financial advisor. This is not legal/financial advice. If you have concentrated position, consider whether to sell part at each unlock window or hold. Many advisors suggest setting a rule-based diversification plan rather than guessing exact tops or bottoms. Remember taxes. Holding past 1 year can trigger long-term capital gains, but may expose you to more price risk. Balance those factors. Stay calm and diversified. History shows IPO stock surges often reverse on lockup expirations. Being informed, not fearful, is your edge. Even if SpaceX is a great company, expect short-term noise. Use these known events to your advantage. Patient investors might even find buying opportunities after each lockup-induced dip. SpaceX's IPO lockup is not a single cliff, but a rolling release valve. Insiders are scheduled to drip shares into the market in stages. Unlike traditional IPOs, SpaceX investors must weather multiple unlock dates over the next 6 to 9 months. Past IPOs show that such scheduled supply shocks often coincide with price pressure. Field and Lowry, greater than 1% drop on average, 60% of issues fall on lockup end. The good news is that Musk himself is locked for 366 days, showing his commitment, but other insiders will be selling well before then. If you own SpaceX stock, especially via an SPV, expect volatility. It won't be one sudden crash, but multiple selling waves. Knowing exactly when and how much can help you stay prepared. Mark the dates, understand your exposure, and make informed decisions. That's how you turn hidden prospectus details from a trap into a tool. Sources: SpaceX S1 IPO prospectus, lockup terms, academic IPO studies, legal analysis, press coverage, for example TechCrunch, of SpaceX SPVs and past IPO